What's going on, guys? So, I want to come at you with another stock pick of the week. This week, I want to talk about Ideanomics. And if you go back and watch last week, I had a short position in the company, and I had made a video discussing that position, and it seemed to be a pretty popular video. And this company seems to be pretty popular right now with Robinhood and all kinds of investors and day traders. It seems to be getting a lot of volume. There's a lot of volatility in the stock. It went from like $2 or 50 cents to $1.50, then to $2, then to $3, and it was almost at $4, and it basically started to shoot back towards $1.50, and I shorted it around $1.80 and covered in the 138 range. So made a little profit there. And I had discussed in that video that I wasn't necessarily shorting the company because I didn't like the company, or that I didn't believe that they were going to be successful in the long term, but because I had seen there was a lot of shorting volume on the short seller report by Hindenburg, so that was a catalyst for a short position. Doesn't necessarily mean that I think the company is going to fail or that I don't believe in them. So that's why I wanted to make this video, to discuss the company and discuss why they could be successful, and why I'd also been high on them last year. And I had written an article about this company last year. So before I get into that article that I wrote last year, I want to just kind of give you the details of what this company is about. So this is their mission. So Ideanomics is a global company focused on facilitating the adoption of commercial electric vehicles, and developing next generation financial services and fintech products. So fintech is financial technology. Its electric vehicle division, Mobile Energy Group, provides group purchasing discounts on commercial electric vehicles, EV batteries, and electricity, as well as financing and charging solutions. Ideanomics Capital includes DBOT, ATS, and Intelligenta, which provide innovative financial services solutions powered by AI and blockchain. MEG and Ideanomics Capital provide our global customers and partners with better efficiency and technologies and greater access to global markets. The company is headquartered in New York City and has offices in Beijing and Qingdao, China. So what this company is trying to do is to focus on kind of next generation energy, which is trying to introduce electric vehicles into Asia, and to try and develop financial technological services around blockchain and artificial intelligence, which means they're trying to go to the future, look to the future, and try to kind of build upon a lot of the things that are starting to blow up, like Shopify and Amazon, all these kind of online services and platforms in which they want to kind of utilize to develop their brand and their different divisions. So their divisions here, as they said, kind of they're the Mobile Energy Global is their electric vehicle platform, where they're trying to push electric vehicles, the development of electric vehicles into China. And then Ideanomics Capital is their financial services ecosystem, they call it, including AI and machine learning solutions. So they're trying to develop a fintech village in West Hartford, Connecticut, and this financial village will be like kind of like a university / like global headquarters for technology and innovation, as they call it. And it's kind of going to train the next generation of financial and technological geniuses, and try to develop their technology and develop their kind of ideas for how they think these things can be implemented across the globe. So that's what they're focused on. They're kind of the divisions of their company and where their main kind of interests lie. Now, as I said before, I wrote an article about this company over a year ago. In this article, I talked about how they are going to be harnessing some of the most lucrative developments, or I should say industries, coming into existence, or that are kind of coming. My webcam is messing up there, but that are kind of coming online, or that are kind of, that we see coming, that are developing, that are kind of building that are gathering momentum, especially with the whole COVID lockdown. We're seeing a lot of more people getting into financial technological services, people relying more on online platforms and businesses rather than brick and mortar stores, because they don't want to be associating or going out in public more often than they need to. So this is kind of encouraging people to embrace the future and embrace all of these kind of new technologies, and also the whole climate change thing, because as COVID-19 has kind of shown that we can reduce kind of greenhouse gas emissions if we reduce the amount of pollution. So that means the amount of traffic and the amount of kind of I should say people, like mobilization, the amount of actual people going out and driving every day, and kind of or the businesses and the corporations and the way they pollute. So like reducing greenhouse gases by revolutionizing either the technology or by introducing things like electric vehicles. So that's one way that we can kind of, instead of forcing everybody to work from home to reduce emissions, you could say they would drive electric vehicles instead of gas-powered vehicles. So that would kind of lead towards a more greener future, and something that I think a lot of millennials and new age investors are kind of interested in. So with the Nikola trucks or whatever, that IPO that just went public, and Tesla and all these other kind of electric vehicle manufacturers that are very doing very well and are very popular amongst millennials and kind of new age investors. So that's something to keep in the back of your mind. And as I point out here, the recent growth in artificial intelligence, cryptocurrency, and blockchain technology has created an unprecedented opportunity for investors. Blockchain alone was worth $315 million in 2015 and is expected to grow to $20 billion by 2024. CompTIA, the world's leading tech association, estimated that information technology market in 2019 will reach $5 trillion. The U.S. is leading the charge, yet North America only represents 31% of the global IT market. And this is the point of kind of this company, is that they're not trying to do this in the U.S. They're trying to do this in Asia. And it's kind of an interesting thing, and one of the reasons why this stock is very volatile and also is very I don't want to say like untrusted, but it's very risky. It's a very risky investment, because if things happen between China and the U.S., say there's like a trade war or increased tensions between the two nations, then you could see a lot of volatility in this stock, and especially because other stocks, specifically Luckin Coffee or a few other Chinese companies, have come under pressure recently because of their untrusting methods, or their kind of ways that they are doing very sketchy stuff. They're overrepresenting their kind of customer base, overrepresenting their different financial numbers. So these kind of red flags are popping up between companies that are focusing on Chinese markets or Chinese companies that are looking to trade in the U.S. It's still an issue, but with this company, because they're based in the U.S., I don't see that being as big of an issue as it is with some other companies. But anyway, it's something to keep in the back of your mind as well. So as I say here, the catalyst for all of this, for the massive explosion, will not necessarily come from North America. It could come from Asia, specifically China and India and Japan and Korea, and also countries like Malaysia, Indonesia, all of these kind of Southeastern Asian countries that are up and coming and will want to develop these new technologies, and possibly Ideanomics is the company to do this. They're definitely making headway in Malaysia, as I'll talk about in a second. But one company set to capitalize on the exponential rise of the IT market is Ideanomics. Ideanomics is a global leading fintech company with its headquarters in New York. They offer cloud-based software and services and specializing in developing digital asset securitization through AI and blockchain technologies. So that's their financial services component, and that's kind of where they see the most profit currently in regards to developing kind of online platforms and financial services through a lot of Asian companies, like Beijing Central Finova Financial Services and the National Transportation Capacity. These are different agreements in which they are kind of helping to digitize their industries and help bring blockchain and AI technology into Asia. So, although the company is, doing all these things and signing all these agreements, this was last year where I talked about that they signed an agreement with National Transportation Capacity Co. NTS to be the sole distributor of the electric tour bus conversion business in China. That is estimated at $118 billion. China has mandated that all buses must be converted to electric by 2022. So with this agreement, you can kind of see that they are making headway, but this was a year ago and nothing has really came of it. And that's something about this company that you'll see is kind of sketchy, is that they have a lot of interesting ideas, and they have a lot of press releases, and they hype up what they're doing quite a bit, but it's hard to see whether a lot of that hype actually becomes profit. And it's one of the reasons why Hindenburg put out their short seller report, is to allow people to understand that just because a company has all these great ideas and is putting out press releases that sound amazing, and they're signing these deals, we have to see companies become profitable and actually start to deliver on some of these deals, instead of just sign them and then nothing ever happens from them, or they overrepresent what these deals actually are, and then in the end it amounts to being nothing, or maybe the deals weren't even there. They were just kind of claiming, because a lot of times these Chinese companies, they don't necessarily have to disclose anything, and if they claim to make an agreement with a Chinese company, it's kind of hard for us to understand whether that agreement actually exists unless we have some knowledge of what's going on with these Chinese companies. So that's one of the issues with this company. And as they say here, lastly, Ideanomics has purchased 11.22% of Tree Manufacturing, which is Tree Electric, the only licensed electric vehicle manufacturer in Malaysia. This deal includes the exclusive rights for electric police vehicles and 60,000 electric city buses. And again, this was over a year and a half ago that these agreements were all signed, and that these were basically put into motion. But we still aren't seeing anything from these agreements. And the EV market is set to explode in Asia, and is currently valued at $6.7 billion. With these agreements, Ideanomics has positioned itself for a further expansion into the green tech world that is quickly coming to dominate. So that Ideanomics is quickly coming to dominate. And that's a funny thing, because I wrote this article a year ago, so you can see back in 2019. And I just was bringing up then that there was a lot of upside to this company, and that there's a lot of room for growth and expansion, and this stock could skyrocket if they are able to fulfill a lot of their promises, and if they are able to follow through on a lot of these developments, they could be a very successful company. And that's something that I pointed out in this article, and that I truly believe, because of the way that they're trying to harness the future and harness the kind of new age perspective on technology, on climate change, on electric vehicles and greener technologies and more kind of digitized blockchain AI solutions that are becoming more and more popular. So in 2019, the company's revenues were $377 million, 161% year-to-year increase. The increase in yearly revenue has been attributed to the logistics management of crude oil and consumer electronic assets. The company intends to utilize this approach for the development of blockchain and AI solutions to crude oil and consumer electronic supply and demand. The goal of Ideanomics is to be able to offer cutting-edge fintech and green tech services that incorporate blockchain and AI solutions to a vast array of applications. The company was founded by Shane McMahon of WWE in 2014 and is set to lay the smackdown on the global IT market. So that was the article that I wrote over a year ago. And it's interesting that this company put out some more press releases earlier in the last couple weeks that kind of pumped up the stock again. And again, it became one of these things where it was like, oh, look what these guys are doing. These guys are doing such amazing things. You know, let's take a look and let's actually see if they can do something with these, because if they can, this could, you know, this stock could go to the moon. You could see this easily climb to, you know, 10, 20. It's easy to see that because of the opportunities and the actual profits that you can get from trying to develop electric vehicles in China. And as you pointed out in my article, they've mandated that all electric, you know, city buses and transportation services need to be electric by 2022. So this is a great opportunity in the next year, basically year or 2 years, for Ideanomics to cash in. Will they? Well, that's the big question, right? And nobody knows, which is why I still think it's kind of a risky investment. I'm not saying you shouldn't invest in it, especially if you have time to hold the stock, because I believe this stock could, you know, might be a few years before they see serious profits and before the stock actually, you know, gives you a serious return on your money. But I also think that if they can do what they say they're trying to do, this stock could be very, very lucrative. It could be a very, very good company. But like this press release, I don't see anything that makes me, like, you know, amazed, because like I said, I've been here before. Last year when I was reading all this, when I did that research, I was kind of like, whoa, this company looks great. Look at what they're doing. Look at what they're, you know, this thing's going to go to the moon. And then I watched their share price do nothing for almost a year. And they kept putting out releases. Oh, we're doing this. We're, you know, another $5 million deal, or you know, we signed a new agreement with this Chinese, you know, city, or this kind of electric vehicle manufacturer. And you know, it's not that they're not making headway, because they are. You know, and this Tree Electric in Malaysia is one of the biggest reasons why they are making a big push into Asia, and they may be able to do something. You know what I mean? Like, they may be able to do something with this, but it's one of those things where I'm not going to tell you that it's going to be an amazing investment and the stock's going to go to the moon 100%. There's high upside to this, but there's also the risk, like I said, that it is just a pump and dump, that they are just putting out press releases to show, oh, you know, we signed another $2.5 million deal. Like, if you look at their finances, they're not that amazing. Now, something that is interesting is that a lot of the ownership, or a lot of the institutional owners are high up in the company. So the CEOs and the founders, Shane McMahon and Bruno Wu, still own large positions in the company, almost 25% between them, right? And other members of management and members of the institution still own quite a bit. Upwards of 40%, almost 40% of the stock shares are owned by 66.5 million are owned by insiders in the company, which is a good sign. It means they still believe in the company. These are all their affiliate partners. A lot of them I've never heard of, and I don't know much about them, so I'm not going to claim that I do or speak on them, really. You'll have to do that research for yourself. But they do have an interesting uh, idea, and they have some interesting people within their corporate management that make me believe that there may be something here. Bruno Wu is a very intelligent investor, and he, you know, he's done a lot with his company from the beginning, and he's also involved with a lot of other businesses in China as well as in the United States. And Shane McMahon, obviously, everybody knows, is the son of Vince McMahon, the owner of WWE, and he is part owner of the company as well. So that provides you a little bit of understanding that these people at least have, you know, money, and they're not necessarily just trying to profit from this company instead of trying to build it up and actually embrace the future and have some sort of belief that they can do what they say they can do. So that's one thing there. And Alfred Poor, the new CEO, has been doing a lot of press releases. He's been speaking at a lot of events. He's been being very doing a lot of PR. He's doing a lot of public relations, and it's just interesting to see. But again, we're still kind of left unsure of what's going to happen. And if you read this article here, if you want to go check out about the financials of this company, go read this article here. It's an interesting article, and I think it has some pretty good insights into it. As they kind of discuss how the company has been able to still be profitable and still be kind of growing every year, even since the last press release, or the last numbers that I showed in my article. They had grown 196% last year of March from the year before, and this year they were able to grow again by almost 96%, and that's gross profit margin. So he talks about how, like, the electric vehicle revenues ratios are a lot higher than conventional vehicles. So it's a good margin of profit. So there is a lot of upside, but he also mentions that without positive net income per share, if the company does not receive additional financing soon, it may have to stop its activities, which makes the stock a bit risky. Like most occasions, the higher this risk, the larger the stock return. In less than 1 year, the share price increased from 30 cents to more than $1.90. And he kind of discusses, you know, where the company started, which was offering premium content videos and on-demand services in China, and how they've kind of continuously tried to repurpose their ideas and where they were going to focus on. So they were, like I said, he says here that they decided to trade petroleum products and electronic components through the usage of blockchain and AI technology, as they talked about in my article. And while this investment idea looked, in his opinion, very attractive, in 2018 they decided again to stop its activities and kind of retool to go forward with electric vehicles and the introduction of the kind of electric vehicle chains into China. And that's kind of where their main focus is today, with their MEG Mobile Energy Group business unit. That's their main focus today. And the company's website appears to be selling energy easily thanks to robotic technology, revolutionary electric vehicles, and the Internet of Things, among other innovations. I could not find a significant amount of information about patents and the company's technology. According to the most recent annual report, the net balance of the company's lived intangible assets is worth $52 million. So that's down quite a bit from last year, which was over $100 million. And many of the company's tangible assets are not related to the company's technology. The influencer network is worth 1.7, and the land use rights are worth more than 27 million. And he mentions down here that the company only disclosed one patent, which is worth 28,000. So they haven't developed a ton of technology, is what he's trying to say there. They've mainly developed or bought in a lot of the technology, or at least acquired it through purchases rather than development. Many of the company's tangible assets were acquired from other companies, as he mentions here. Thus, I thought that investors would appreciate getting to know the businesses acquired. So among the companies, there's Grapevine Logic, which was acquired for 2.8 million, including goodwill of 0.7 million. So as he said, he does not know whether this was a good purchase, but he thinks it was a little. He talks about here how he thinks it was a little expensive, how they paid a lot for a company that doesn't really have a lot of revenue, or that hasn't shown that they have any, valuable assets other than being, I know, other than, as he says here, being owned by Dr. Wu's associates. So basically, the company is 35% of the company is owned by associates of the CEO of IDEX, of Ideanomics. So that's an interesting concept. Like, that's an interesting thing to kind of, is that the company that they acquired for basically $3.5 million is owned partially by acquaintances or affiliates of Dr. Wu. It's just an interesting thing that, like, you're buying up a company that your buddies own. Just an interesting thing. A company doesn't have a ton of value. So why are you know what I mean? It's kind of one of those things that this company, I'm not saying they're bad, and that's the thing. A lot of people hate me because they say, oh, like, I got a lot of hate about shorting stocks, and like how, why are you shorting this company? It's like such a good company, or I shouldn't be shorting at all. But people got to understand that when you're trading stocks, you like short sellers. If you're a long-term investor, you want short sellers because they help to bring the stock down. And if you're a long-term trader or a long-term investor, you're like, hey, it just allows me to buy more shares of that company that you love at a cheaper price. Like, there's no reason why you should not, believe in a company. If you invest, a long-term investor, you should be able to take any kind of volatility in the short term, as long as you see significant returns in the long term. And that's what investing is all about. And that's the difference between investing and trading, is that when you're trading, you're just looking at the day or that time frame, like a week. You're not looking at a long-term investment. And that's one of the reasons why shorting shouldn't be looked at as such a negative thing, because a lot of shorters actually help stocks go up too, what they call a short squeeze, where shorters get in and the stock starts going up, so then the shorters have to cover their position, and then the shorts lose money to the people going long. So there's always a yin and a yang. You need a balance where there needs to be shorts or there needs to be buyers in order for the stock price to move, and neither side is wrong or right. It's all about making money. And if you're a long-term investor, you should be believing in the stock for the long term and not the short term, unless you're just a trader. In that case, you should have a plan and stick to your plan, rather than just get angry if the stock price goes way down or way up. You should already have a plan for that. So anyway, I just wanted to throw that out there. He talks about here how the company still has short-term convertible notes worth approximately $7.5 million, and the current amount of cash is less than 70. So I would be expecting conversion of debt or a capital increase, saying basically they're going to have to need money. They're going to have to try to raise money or convert their debt in order to keep paying for their further kind of development of products or their further acquisitions, or keep paying their employees. As a result, the intrinsic valuation of each share would decline, which may drive the market price down. So he's saying if they were to convert this debt, they would be able to raise money, but at the same time, it would hurt the share price in the short term. So, and then he says that if the market truly believes in this company and the technology that they have, then equity dilution may not be an issue. So then you shouldn't be worrying about kind of short-term dilution if you're fully convinced that this stock and that their technology is going to revolutionize the world, or at least Asia, in which they hope they can be profiting from their kind of technological innovations, and they're trying to transition into electric vehicles throughout. So he also talks about promissory notes and the amount of uh, promissory notes was equal to 19 million in the next 2 years. The company cannot monetize its intellectual property. I would expect a decrease in the company's valuation. I remind you that the holders of the company's senior secured convertible notes require payment of 10% interest rate. In the United States, with a non-interest rate close to zero, 10% interest rate appears to be expensive. So he's just talking about their kind of different forms of debt that they have, and that when they need to pay these things back, or when these loans are called, or even if they don't pay them off soon, they have extremely high interest rates that they're not necessarily sustainable for the long term if they can't make profit and pay these things down. And he talks about, basically here he's just talking about how they made more profit back in 2018 when they were trading crude oil, and their kind of consumer electronics focused businesses were much more profitable than the profits that the company made in 2019. As you can see, they only made $1.5 million, and sales decreased to $44 million, but the gross profit margin increased from 0.8 to 96%. The company transformed its business model, so the margins were higher than those in 2018. I do appreciate this fact. So he's just basically saying how although they were making more money before in 2018 by trading petroleum products and servicing consumer electronics, they were actually more their margin rates were actually more profitable in 2019 because of their transition to electronic vehicles. So if they can increase their sales and kind of build on this exponentially, they could see extremely higher sales and profits. With that, notice that in 2019 the company had to report a significant amount of impairment of assets. It usually happens when companies discontinue one of their businesses. Total amount was equal to 73 million, which leads to total operating expenses of 111 million and 68 million. In 2019, the net loss was equal to 96 million. So he's kind of showing you like the difference in gross profit. So revenue costs were 1.5 million in 2019. But revenues were 44 million. So the actual gross margins were actually a lot higher than back in 2018 when they actually had cost of revenue. Their cost of revenues was $374 million. So they actually only made $3 million in profit in 2018, whereas they made $43 million in profit in 2019. But they also had a massive impairment of assets charge. And that's what he's talking about here. And that's, like he said, you have to write down debt, or you have to kind of write off businesses. And that's what they did in 2019, which is why their overall net loss was significantly higher in 2019 than it was in 2018. And it's simply because of this kind of write down. Now, generally, this is a once in a time thing. It's not something that you do all the time. But it is an issue if they're not able to ramp up these kind of electric sales and these developments to, or I should say partnerships with a lot of these Chinese cities and businesses, so that they can drive their sales and actually start to make profit instead of net losses. And that's kind of one of the issues with companies that are not purely profitable, or not showing that they can be consistently profitable in one market, rather than switching markets every couple years, and then being profitable but not showing consistent steady profits for a good amount of time. So that's one of the issues with a company like this, and this brings me to the difference between investing and speculation. So one thing I learned early when I was investing was that there's a difference between investing and speculation. And when you're simply investing in a company that you don't know much about, or you're not fully sure how they're profitable and how they're going to be profitable, they may have an idea, they may have great press releases and great kind of articles, or they may have a great technology or whatever it is. If they're not able to consistently show revenues from these products, from these technologies, and from these developments, then you need to be very cautious, or at least understand that when you invest in a company like this, you're speculating, you're not investing. And there's a big difference. When you're investing in a company that's proven. So, for example, it's Coca-Cola. If you invest in Coca-Cola, it's an investment because they've shown that they can be consistent for decades and consistently profitable, consistently generating profit, consistently, increasing their revenues. This is what investing is. It's understanding what a good company is and that you're buying shares in that company because it's a good investment. Whereas when you're buying shares in a really cheap company, what they would call penny stocks, or cheap stocks that are in highly speculative businesses and that are not consistently profitable or not profitable at all, this is when you're speculating. So this is the difference between investing and speculation, and in my mind, buying shares in Ideanomics is speculation. It's not investing. So I'm not saying speculation is bad. I have a lot of investments that are speculation, but I understand that they are speculation, that I'm not 100% sure that they've proven to me that they can be profitable off of any, no matter what their promises are. So anyway, I don't want to make this video too much longer. I know I've probably already gone way too long, and that was one of my other, big negatives, is that people say my videos are always too long. But guess what? I like to make my videos as long as I think they should be. I think, if I'm going to delve into a topic, I want to delve into it. I don't just want to hit you with like, oh, these are the 3 things and here you go, because everybody likes short, little, succinct ideas because they're not capable of handling large concepts or a lot of information, which I think is one of the issues with kind of a lot of people nowadays, is they kind of are so short-term minded. They just, they're reactive, they're emotional because they don't have the ability to kind of, I don't want to say focus, but to think things at a higher level and to be able to kind of see the bigger picture, in other words. Anyway, the rest of this article basically just points out how the share price will consistently be quite volatile until they can prove that they can be successful. The valuations of this business have ranged between 450 million and 200 million. If we assume sales of 1 billion or 140 million from their EV revenues, and the company can continue to deliver on their gross profit margins of 96%, then the investors believing that the growth will continue will buy shares. He says then you should buy shares. If you believe they can consistently make these kind of revenues and consistently show these kind of profit margins, then it's a good investment, is basically what this guy's saying. That's not what I'm saying. And you shouldn't invest in something just because I say it. You should invest in something because you believe in it, and you believe in the technology or the concepts or the founders and whatever it is. You need to believe. And if you're not sure of the company and if we're not seeing consistent profits, then you need to understand that you're making a speculative kind of purchase. It's not a bad thing, but it's not necessarily gonna it's not gonna teach you much about value investing. It's gonna teach you that you need to be able to handle the volatility. If it's going to go up, it's going to go up. If it's going to go down, it's going to go down. But if you believe in this company, then you need to hold them for the long time. And that's one of the risks you take in investing in this company. So as he said before, they have not shown consistent positive cash flow. Even when they make 44 million, they're still showing a net loss of 98 million. So they're not consistently profitable. They haven't shown us that they can actually be profitable consistently. And like I said, their revenues have increased. This year they've shown from their electric vehicle purchases that they can be profitable and have high gross margins, which means that they could be very, very successful. But we need to see that, and that's why, like, in my opinion, I won't be investing until they can show me and prove to me that they can do that. And then I will invest for the long term. And I do believe this company can be very, very successful. But as I said, it needs to be shown. So that's my kind of take on Ideanomics. That's what I want to talk about today. And I'm sorry if this video is way too long. I apologize, but I had to do what I had to do. So thank you for watching, and I will hit you guys with another video soon. I know this thing was long, and I'm sorry about that. If you guys want to complain, complain. I don't really care, because I do these things for me and for you guys, but it just helps me understand and kind of conceptualize companies and think about them from a larger perspective. Anyway, have a good day. Bye-bye.